Okay, so I've already looked at Electronic Arts and Activision Blizzard, and today to add to this series, I'm going to take a look at Take-Two Interactive Software. So these guys are another cool computer game developer with their blockbuster titles Red Dead Redemption and Grand Theft Auto. And just like my previous videos on Electronic Arts and Activision Blizzard, my inner child really wants to invest in this company, but let's analyze it properly. And if this is the first time to my channel, well, welcome. My videos are about investments that anyone in the world can make. So this statistic still just blows my mind, where the average US gamer's age is 35 years old. The average number of years the US gamer has been playing is 13. And only 29% of the gamer population is under 18 years old. So when I think of computer games, I think mostly of my childhood, but that's actually not what's happening here at all. See, these gaming companies are selling to adults, mostly male and mostly middle-aged. So this becomes a really big business because middle-aged adults, well, they're the ones who have money. And if you have watched those previous videos of mine, you'll know that I'm really bullish on the gaming industry as a whole. So I think with 5G technology rolling out across the world and more people every day getting access to the internet for the first time, well, I just think this is great signs for the gaming industry as a whole, which is going to get better and better. Now, the big talk in the gaming industry is the growth of esports, but this is mostly led by Activision Blizzard. It's not really Take-Two's domain. So another very important thing that's about to happen in the gaming industry, which is often overlooked by most analysts out there, is that higher gross profits are coming. Now, I've listened to the CEOs speak, and they've all been mentioning that the $60 price point, which is generally consensus for a computer game nowadays, well, that's long overdue for an increase, and it's probably going to go up to $70 very soon. So in my opinion, that move from $60 to $70, well, it's not going to affect sales at all, but it's going to be a big jump to the earnings. Now, the competition is strong in the industry, and some of the big tech giants have parts of their business in the gaming space. So what I'm talking about are companies like Tencent, Google, and Microsoft, and they're significant players in the industry. And then you also have the dedicated gaming companies like EA, Activision Blizzard, and Nintendo also competing for that market share. But I think after analyzing both EA and Activision Blizzard that the industry can definitely handle this amount of competition. So I think for these established businesses with decades of expertise, it's going to be really difficult for a newcomer to rise up and compete against those big dogs of the industry. Besides competition, I actually don't see any other major threats in the industry. The industry is actually one of the most stable growth industries that I can think of. So Take-Two are expected to gain traction from solid demand from these titles. There is NBA 2K20. Now, 2K19 was the second bestseller across the industry in 2019. You got Borderlands 3. It was 4th in the industry. Grand Theft Auto Online and just Grand Theft Auto 5, it was 11th in the industry. And Red Dead Redemption 2 and Red Dead Online, well, it was 12th in the industry. GTA 5 actually sold 130 million copies in the last fiscal year, and that ranks it amongst one of the best-selling games of all time. This is an unbelievable franchise game, and it's going to serve the business really well for a long time. The game has already been popular for decades, and the quality is just getting better and better. There is no other game quite like it, and I think the popularity will just remain solid. So the whole world is moving towards a subscription Netflix-style business model with in-game purchases. So with Take-Two moving GTA and Red Dead Redemption to these types of business models, well, I definitely think they're doing the right thing here. So the rest of this year and 2021 is going to be really positive for the gaming industry as more and more people join these online worlds like never before. Take-Two's latest financial results actually show that 58% of their revenue comes from sources outside of just selling games. So things like in-game purchases and subscriptions, and most of this has actually come from GTA and the NBA 2K games. The last quarter was actually one of Take-Two's best financial quarters ever, and they didn't even release any new games. So for the 3 months that ended 30th of June, they made $540 million in revenue, and that's a 39% increase from their performance last year. So it'll be interesting to see whether this has already factored into the share price. But before we get there, we really need to go over the finances. Now, with any business, to check the financial health of the company, we need to look over these 3 areas. Can they handle their debt? Are they growing? And are they a well-managed company? Now, please don't leave the video because of the terminology that I'm about to use. Don't worry about it. Just sit back and relax. Try to get a feel for what's happening. It's part art and part science anyway. Now, I've put a lot of effort into this video and I have no idea whether people even like it or not. So if you could hit that like button for me, it at least gives me some feedback. It's really important to look at the company's debt because businesses generally can't really go bankrupt if they don't have any debt. Debt is the reason they get into trouble. So to see if the business can handle its debt, I go through the debt to equity ratio and the current ratio. So Take-Two actually don't have any long-term debt, therefore they don't have a debt to equity ratio, so that's perfect. And the current ratio is sitting at 1.72 right now, and that's well above the 1.5 that I look for. So nothing more to see here, let's move on. So in the finances, to check for growth, I look at the book value per share, the earnings per share, the operating cash, and the gross margins. And sure, 2020 is going to be a bit of an exceptional year, so I want to think about that when I'm looking at these charts. This is the book value per share, and it's solid growth since 2016, so that's good. This is the earnings per share, and again, great growth since 2016 here for Take-Two. Look, I'd much prefer to see 10 years of solid earnings per share growth, but 5 years, I'm okay with that. This is the cash generated from operating activities, and there's more growth here since 2016, so that's good. This is gross margins, and this is something that I've been focusing a lot more on lately. I think it's a big positive when a company can grow its gross margins because they're doing a lot of things right. Now, Take-Two's gross margins look solid, but they are nothing compared to the 75% gross margins that EA and Activision were able to produce consistently. So I am happy to give them a tick, but both EA and Activision had far better gross margins here. Now, although it'd be cool, we can't just go in and sit in a meeting with the management team to check they're making good decisions. So instead, we have to look on the return on equity, the free cash flow, and their cash in the bank. So this is return on equity. And I want to see return on equity above a 15, as it shows management are improving the value for the shareholders. Now, sometimes there's a little bit of a trick here. It's actually better to look at the return on tangible equity rather than the return on equity. Let me explain. So this return on tangible equity actually calculates the return on equity, but it doesn't factor in the intangibles, things like goodwill. So an example of an intangible is a brand and how much that brand is worth. Well, look, that's very subjective, and look, it's easier just to leave it out and we get a return on tangible equity as a better figure for good management. Anyway, Take-Two's return on tangible equity currently is 19%, which is solid, but Activision Blizzard, as a comparison, is 77%. This is the cash in the bank, and it's been improving, great to see. This is the free cash flow, again, good growth here, that's all we really need to see as well. So regarding management, I'm happy to give them a tick overall. So as you've seen, that's pretty solid financials from Take-Two. I'm really not concerned about anything we've seen so far. I would have liked to have seen higher gross margins because I'm comparing them against EA and Activision Blizzard, which are both significantly higher. And I guess if I'm comparing those companies against Take-Two, well, return on tangible equity could have been higher as well. But a big positive is I love that they don't have any long-term debt. So I guess we have to just go see the valuation now. Now, I have made the calculator that I'm using here, and it's called the Intrinsic Value Calculator. And if you want a free copy for yourself, well, it's free and it's in the description. Now, what I mean by intrinsic value is essentially what the share price should be based on its financials today. And obviously the stock market isn't perfectly efficient, so the share price could be way higher or way below this, what I would call intrinsic value. And what we're hoping to do is buy it at a significant discount to this intrinsic value. So that's what we're going to calculate right now. So the data inputs that I've used for Take-Two are the growth rate that I've averaged from the analyst, plus a bit of my own opinion here. I've said 13% for the next 5 years. Then I want to be conservative and drop that down a little bit for the next 5 years, so I've put that as 10%. Now, I've actually got the discount rate as 8.5% because that's going to give us intrinsic value. Now, it's just rounded it up to 9%. The multiple I could sell it for after 10 years, now I'm using 18 here. You could be a little bit, we could go to 20. I prefer 18 for gaming companies, but 20, 18, either of those is okay. The operating cash flow minus maintenance capex. Now, it's actually easier to find the free cash flow number. So I've just grabbed the free cash flow number here, and the shares outstanding, and these are both in millions. So it's giving us an intrinsic value. This is what the share price should be worth right now of about $270. What I want to do is find a good discount to this. So I want to find what's called a margin of safety, a better buy price. So I like to put 20% as my margin of safety here in the where it says my return on investment goal. Now that gives me a buy price of about, call it $120. That would be a great entry point to this company. Now remember, these are just my estimations. So if you think the growth rates are going to be higher than what I think or the analysts think, then just put in higher growth rates. You can play around with the numbers here as much as you like. But please just don't forget the margin of safety because we're making a lot of assumptions here and you need some room for errors. Now, the current share price as of the end of October is about $170. So I do think that Take-Two is under intrinsic value, just not enough for me to feel good about the margin of safety. I think it needs about a 20-25% pullback, which is possible, I guess. Okay, so do I want to invest in Take-Two Interactive? Now, like I said, I'm not buying them today and I'm probably not buying them anytime soon. What I'm going to do is I'm going to put them on my watch list because they are a great company and I'm just going to wait. Now, I might never see the price that I'm wanting to pay, and that's totally okay. I think it's totally okay because there's so many investment opportunities out there that I don't need to chase anything. But I do think the future is very bright for the company. They're in a growing industry and their financials are solid. But honestly, I actually think I like EA and Activision a little bit better because they have better gross margins and a better return on tangible equity. Now, I'd love to hear your thoughts on this investment because I know a lot of people out there are going to think that Take-Two is a fantastic investment and I'm just being way too conservative. And remember to hit that like button for me and hit subscribe if you enjoyed my analysis, and I will see you in the next video.